All right, so Christy and I were just talking about our strategy now in investing in real estate, how we want to start buying, what we want to stop doing versus what we want to keep doing given the pandemic and the COVID-19. So we've been thinking about this a lot. You know, we had some projects in play during this time. Like we've got one house that is a flip that we put on the market, and it is now on the market for sale retail, and the showings have been pretty scarce. And it's in a desirable area of our market area in Jacksonville, Florida. But we're not getting a whole lot of showings, right? So we're trying to figure out how to creatively, get it out there so that we can get some interest from some retail buyers. We had a property, we buy and hold. We had a property that actually we put a tenant in it, and we were going to start the refinance process, and all of our lenders that are asset-based lenders pretty much stopped and put a pause on that lending. So, luckily our private lender is going to work with us and keep us whole during this whole process as we see how the market shifts, right? So if you look at what we do, right, we buy and flip, we buy and hold. Things are shifting for us. We can't necessarily buy and hold and do it the way we've been doing it because we can't get our financing put in place right now. We don't know when that's going to open back up. From a flipping perspective, there's some risk. We don't know if people are going to continue to buy. We're already seeing that is shifting in the marketplace. So we're talking now about, well, what should we do during this period of time? We don't want to stop investing. We're investors. We want to continue growing our portfolio, right? We want to continue to increase the wealth that we have. We have money sitting that isn't making money right now. So what do we do to get that money out working? So one of the things that we've talked about is moving into continuing to buy properties, but looking at only buying hold properties where we can get seller financing or buy subject to. So that's a thing that we're talking about now. And I think that that's a good approach because people still need a place to rent while the market is still out. We don't know what's going to happen with the rental market. We know that people still need a place to live. So, and we actually just rented one, right as this whole thing was transpiring. We rented a property in a more, I'll say, desirable area, right? So the rents are a little higher. So I do think that we have to be cautious about, where we might be buying, even if we are considering buying with owner financing or subject to. But here's why I think, and Christy, if I want to hear your thoughts too. But this is why I think it's a good time right now to be trying to buy, even if you're a wholesaler, to buy with getting owner financing or subject to, because sellers need to still sell. So if you're finding those motivated sellers that truly are motivated, they need to sell. It's not that they want to sell. It's not that they just want to cash out of a property that they have. It's that they need to sell for some motivational reason, right? Like they're going through a divorce, like there was a death in the family, like they can't afford to pay their taxes and their taxes are due, or they haven't been doing that for a period of time, or they can't make their payments right now. And maybe that started prior to the COVID-19 crisis, and now they're 90 days in, and now things are going to start heating up. I mean, I know there's going to be some delays and things happening, but people are going to find themselves back in a position where they still need to sell. So those people are out there.
So before you talk about that, I've seen and heard a lot of people, they don't understand why something like this is affecting the market. They don't understand why. What does a virus have to do with lenders not lending or lending on different terms, or why is this affecting?
Yeah, so just from my point of view, this is what I think about that. So first of all, there's a lot of businesses that are having to shut down. Because of that, there are people who are losing their jobs, or they're not getting paid, or they lost hours, so they're only getting paid part of what they are getting paid, or were getting paid. So, excuse me, there is less ability for people to pay their rent, right? People are not going to be able to pay their rent, their bills. Um, there is the backing in the government financing industry has been pulled, right? So a lot of lenders that were getting backing from the government or getting backing from private investment firms, that has been halted because the stock market has taken a dive. So much is in question about whether people can pay their mortgages, whether people will have jobs, whether people are going to be able to pay their rent. So that is having a triple effect in the financial industries. And so, guidelines are changing with hard money lenders, with even private lenders, what they're willing to do or not do, if they're willing to do it at all. Even in the conventional financing world, guidelines are changing, things are becoming stricter. There's less money to go after because of a lot of that. So the impact is crippling every industry at this point in time.
Okay.
So again, a seller wanting to sell their house, will they really be able to find a retail buyer that can get it financed to buy it, right? And if they can't, can they use creative financing to make that transaction happen? And the answer is yes. And when the interest rates were at all-time highs, and I think this happened in the 80s, but interest rates at some point for mortgage loans went to 18%. And it was before I was investing. My grandfather was investing and was selling real estate as a broker, a real estate broker. And he shared with me that they had to be creative. When interest rates soared and they were at the highest that they've ever been, they had to be creative for how they were able to get sellers, how to make it happen for sellers to be able to sell their houses.
So this kind of stuff's been happening.
It's cyclical.
Forever.
It happens in cycles, right? Rates go up, and we have to address that in the marketplace. How do people sell? How do people get financing when that happens? How do they even afford it at 18% interest rates? Again, our market, like, we've been down. Our interest rates have been low for so long right now since the crash, and they weren't even high when we crashed, right? They were good then. And so while rates are low and you would think that people can get financing, there's probably less people that can get financing. And the guidelines have become stricter, and only if you are a paper right now, probably, right? You got to have a certain credit score, is what I'm being told, in the retail marketplace. Well, for investors, that's even harder now, because while there's flip money out there, the guidelines are still going to be shifting and changing. They're going to be more conservative on what they think the future value of a property is going to be. They're not going to give you as high of LTVs probably on those flip properties. So the trickle effect of all this is going to be pretty big. So again, we were looking at a project that was going to be a pretty cool project. And we've decided that after looking at it, we approached our private lender and somebody who wanted to be a part of it, and they're looking at the market saying, hey, you know what, I just don't think it's the right time not to take that big of a risk. And we're kind of thinking that too, right? Because that was going to be a very large new type of project for us. And now we're going, I really want to do it, and I really see us doing that in the future. But now's probably not the right time. So we're talking about what is the right thing to do right now to stay in the real estate investing game and protect ourselves. Sure, we can find good deals. Sure, we can buy a property and we can start working on it. The trades are out there working. They're still able to get material, although I'm sure that there's some impact there, right? There's probably an impact on
the price of material,
the supply of materials, the price of materials, right? That'll have a trickle effect. So if we think that something normally would take us 6 weeks to do, it might take 12 because of that. We don't know yet how that's going to shake out. But and I really, I didn't even mean to say this, but I want to say this for everybody out there that's investing in real estate or thinking about investing in real estate. This is uncharted territory. We do not know right now yet the impact that we will see. So if you believe that, hey, I can get a good buy on a property, and I can turn this deal, and I can find a buyer on the other side, and I can do it in 3 months because that's what you were used to doing, you better think twice about that. You better be conservative. And you better think, if I thought I could do it in 3 months, I'll plan 6. If I thought I could do it in 6, I'll plan 10. Because here's the reality of this: we don't know what's really going to happen until we see the shakeout. We don't even know if we'll be able to open our businesses back, work out of our physical locations at the end of April.
Right.
That's the target right now. But what if that doesn't happen and they extend it to the end of May? Right? I mean, you can't even go and show a property that has an occupant in it. Like, the risk about doing that right now is significant. If it's vacant, sure, I can take that risk, but actually maybe you can't. I don't know. I mean, I think we
have to read the guidelines.
Yeah, we have to read the guidelines. So we don't know. And you know what? If this gets worse before it gets better, they might say, hey, you're not allowed to do that, period.
Right.
So you taking on a project right now is a significant risk because of the unknown. That's the key here. So going back to what I wanted to talk about, which is, hey, what should we, or can we, or what should we really be doing? Because, hey, let's be honest, some of us have some money sitting and it's not making any money. We have that. We want our money out making money, because if it's sitting in the bank, it is not making much money at all.
So explain a simple owner financing deal. Okay. What that would look like.
So an owner so first of all, one of the things that we're thinking about is that we want to change our marketing up, and we want to market and have our whole script and process be around trying to have a conversation with owners and sellers about doing owner financing. So whether you're a wholesaler or somebody who buys to flip or buys to hold, right? We can all be having these conversations with the seller, and we can shift that conversation with the seller. And can we still buy for cash? Sure. But can you really sell it, right?
Right.
And do you want to use your own cash? Maybe you can get hard money still because you're doing a flip, but can you finance it out? Are you going to be able to find a retail buyer? Because we don't know.
Right.
So for us, I think the safest thing to be doing right now is to be talking to sellers about doing owner financing and or subject to, or even some options to buy, right? So what does that really mean? So let's just say, for example, you're marketing to free and clear properties. So these are properties that, after the research or the lead generation you've done, you believe that these properties have no debt on them. They own them free and clear. So they have 100% equity. So if that's the case, and these are motivated people and they really want to sell, then you can have a conversation about doing owner financing with them. And that looks like you offering them to buy the property and giving them a small down payment, and then paying them interest, and let's even be reasonable, 5% or 4% interest. So you structure this to where they are getting just a little bit of money up front as a down payment, like you would do if you were going to the bank, and then you have payments that are amortized over a period of time. It could be 30 years, it could be 15 years, it could be 10 years. And offer them interest, right? Offer them interest that's going to be better than what they could get at the bank.
Right.
So 4 or 5%, that's a great interest rate, right? That's not a bad interest rate.
Right.
So it's making it worth their while. And then you have this structured payment. You could even do a balloon. You can have a balloon in 5 years. Hopefully in 5 years, we're going to be out of this mess and things are turning around, right? If you said 1 year, maybe that would be too short, right? So that's why I'm thinking 5 years would be good.
But it's whatever terms.
Or not at all.
It's whatever terms you agree on.
It's whatever terms you agree to. But here's the thing. They can get a little bit of money now, right? They can be getting a monthly payment with interest from you. And that is a financing transaction that is done from an investment standpoint. So, I know that there is the Dodd-Frank Act out there. So you have to consider when you're doing any kind of financing that, right? So, again, I would explore that. But if it's investment, right, and they're financing to you, it's going to be non-owner occupied, then I think that falls outside of that act. So again, you just want to make sure you cover your bases, talk to an attorney about any of this. But again, if you structure this owner financing and they truly had motivation, it allows them to sell. Get what they need up front, ideally. Get payments over time, which is great. And there's a lot of pluses to that for them. A, they've sold the house, they've been able to move to the next step that they need to. B, they're getting an income with interest.
Right.
And you could structure it to where it's a 10-year note and then it's paid off. And if you structure that correctly and the rent market supports it, you might be able to cash flow that and then in 10 years significantly cash flow
Right.
that. Or if they really don't want to wait that long, you structure it to where it's 2 or 3 years, right? Or if you're wholesaler, you could do some options with people. You could say, hey, look, you know what, we have a lot of buyers in our network. You know, if we structure this, if you give me this option and we talk about the terms of this option, then you give me this option. And if I can find somebody for you, then, you know,
Right.
I'm going to close, you know, I'm going to come and close this, or I'm going to execute my option. So there's just all kinds of ways to be creative around buying subject to owner financing, that kind of thing. And I think that no matter what you're doing, if you're a wholesaler, if you're buying to hold, if you're actually buying to flip, this is still a great conversation. Because if you have financing on a property from a seller and they vacate, you can still be a flipper,
Mhm.
right? You
Yeah.
can still you can even pay them a little bit more interest if you really want to, and make it sweet for them, right? You could pay them. I mean, you're paying your private lenders or your hard money lenders anywhere from 9 to 12% and a couple of points, right? So think about the points being a down payment, okay? And then you structure it and say, hey, I'll give you 6 or 8%.
Right.
Why not? If you're going to make good money on the back end, why not?
Right.
And then they hold you, maybe it's 2 or 3 years. And now you have some play. You can get in there and rehab that property, and then you can put it on the market. And if it takes you 6 months to find a buyer, you're still good. You're still okay.
Yep.
So I think there's a lot of possibility in thinking like this.